600 tons of gold quietly stockpiled by BRICS, a 100% punitive tariff announced by Trump.
We're going to put at least a 100% tariff on the business they do with the United States.
And a decentralized blockchain system now in the works, designed to eliminate the US dollar from global trade. BRICS is striking back. Well, what's actually happening to the US dollar's throne? Midway through his term, Donald Trump issued a bold ultimatum. Any BRICS nation that creates or supports a currency to challenge the US dollar would face an immediate 100% tariff and be permanently banned from the American market. He called it an economic red line, one that no country would be allowed to cross. According to Trump, the US dollar isn't just a currency. It's the symbol of America's global influence, decades in the making. This wasn't a one-time warning. Trump repeated it across social media, signaling an unwavering stance to defend the dollar's dominance in the global financial system. It didn't take long for BRICS to respond, and Brazil stepped up as the first mover. As the rotating chair of BRICS in 2024, Brazil openly dismissed Trump's warnings and unveiled plans to expand Pix, its domestic digital payment platform, with over 150 million users, into the realm of international transactions. At the same time, Brazil launched SML, a cross-border payment system using the Brazilian real, bypassing the US dollar entirely. Initial transactions were carried out with Argentina, Uruguay, and Paraguay. Though processing speeds remain modest, Brazil is actively integrating real-time payment technologies, aiming for a system that's fast, efficient, and fully independent of the US dollar. This wasn't just a local experiment. It marked the first financial strike against the dollar's central role in global trade. And Brazil isn't standing alone. The pivot away from the dollar is quickly becoming a shared strategy inside BRICS, with an even bolder project now underway, a unified system called BRICS Pay. BRICS isn't stopping at regional payment systems. Step by step, they're building a global financial platform called BRICS Pay, a decentralized blockchain-based system that allows member states to trade directly without relying on SWIFT, the very backbone of the US dollar's dominance. At the same time, BRICS is developing a new reserve currency to replace the US dollar in cross-border transactions. But perhaps the boldest move of all is the massive gold acquisition. In just 2 years, BRICS nations have quietly accumulated over 600 tons of gold, not as a trophy, not as a vault treasure, but as a financial shield for a post-dollar world where each BRICS nation could protect itself from monetary manipulation and external pressure. It's not just Brazil. One by one, other BRICS nations are making quiet yet decisive moves to reduce their dependence on the US dollar. China and Brazil have signed agreements to settle trade in yuan and reais, skipping the dollar entirely. Russia and Iran have linked their domestic banking systems, executing bilateral transactions without SWIFT. India and Russia are now buying and selling oil in rupees and rubles. And South Africa? It's increasing its use of the Chinese yuan in trade with Beijing. But the most telling signal came with the expansion of BRICS, welcoming UAE, Saudi Arabia, Iran, Indonesia, and Egypt. It marked a turning point. Rising powers no longer want to be tied to a financial system built and controlled by Washington. They're moving toward a multipolar financial order, in where the US dollar is just one option, no longer the default. America's sanctions and tariff threats didn't just raise red flags for BRICS nations, they've begun to backfire on the US economy itself. Within just 24 hours of Trump's 100% tariff announcement, NASDAQ fell 2%, the S&P 500 dropped over 1%, and the Atlanta Fed's GDP Now model projected a negative 1.8% growth for Q1 2025, a possible sign that stagflation is on the horizon. Investors are now asking a tough question. Has the US dollar been turned into a political weapon? And if the world loses trust in it, it won't be BRICS that suffers most. Don't look away, because this is just the beginning of a global currency shift that's changing by the hour. In less than 72 hours, China rejected 150,000 tons of U.S. beef, worth over $520 million. Russia moved in immediately to take its place. Is this just a trade hiccup or a turning point in the global balance of economic power? In early March 2025, China abruptly rejected 150,000 tons of U.S. beef, worth over $500 million. No statement, no warning, just swift action at major ports like Shanghai and Guangdong, where shipments were turned away under a single explanation: substandard safety compliance. The official reason was food safety. But just days earlier, the U.S. had imposed a 25% tariff on Chinese electric vehicles and components, impacting over $38 billion in trade. Analysts noted that the volume of rejected beef in March was over 4 times higher than in January, a spike that sent shockwaves through the export industry. This wasn't a port-side technicality. It was a strategic signal, calculated and deliberate. And while the blow may have landed at the docks, its impact struck straight at the heart of American agriculture. Texas, Kansas, and Nebraska, 3 states that account for over 70% of U.S. beef exports to China, are feeling the hardest hit. By mid-March, more than $520 million worth of contracts had been canceled or frozen. Wholesale beef prices dropped sharply, 7.3% in just 2 weeks. Thousands of tons of product are sitting in storage. Cold chain logistics have been disrupted, and the feed supply industry is now facing downstream losses. A Nebraska producer said his $4 million export contract is hanging by a thread, forcing him to sell at a loss in the domestic market, which simply can't absorb that much volume. But here's the twist. These impacted states? They're rural America. The very backbone of U.S. political campaigns. Just as the U.S. was left behind, Russia stepped in. In the first quarter of 2025, Russian beef exports to China surged 32%, reaching 41,000 tons, an unprecedented increase. But the story isn't just about numbers. It's about how Russia planned ahead. As early as 2023, Moscow signed bilateral agreements with Beijing to create a custom veterinary inspection system, unlocking access for 40 processing facilities that were previously restricted. By November 2024, a new rail corridor from Volgograd to Xinjiang came online, cutting shipping time from 28 days by sea to just 11 days by rail. Russia wasn't reacting to a crisis. It was anticipating it. With a deliberate strategy across production and logistics. Russia isn't just selling beef. It's changing how beef is paid for. According to China's General Administration of Customs, 89% of Russian beef exports to China are now settled in yuan or rubles, not US dollars. This allows both nations to sidestep the global financial systems dominated by Washington. But it doesn't stop there. The Russian government has announced a $1.1 billion support package to double beef export capacity by 2027. 3 megafarms are under construction in Voronezh and Kursk, each designed to raise over 100,000 cattle. Russia isn't just replacing the U.S. in terms of volume. It's rewriting the rules of the game. Just 3 years ago, the United States held 12.6% of China's imported beef market, worth over $1.2 billion in annual revenue. But by the first quarter of 2025, that number has dropped below 6%. In the meantime, Russia, Kazakhstan, and other emerging exporters have moved fast, signing long-term contracts, building dedicated logistics networks, and conducting trade in their own currencies. According to expert Deborah Elms, once supply chains are restructured around new standards, new inspection protocols, and non-dollar payment systems, coming back is nearly impossible. The U.S. hasn't just lost its biggest customer. It now faces the deeper risk of being cut out entirely from the global protein value chain. The supply chain is shifting. Will the United States reclaim its position or be pushed further to the sidelines? Don't look away, because what's coming next might just change the game for good. While Americans are paying more for Japanese cars, is Japan preparing a financial blow that could shake the U.S. economy? U.S.-Japan auto trade war. The U.S. has continuously raised tariffs on automobile parts imported from Japan, particularly in the electric vehicle industry. A 25% tariff on auto parts has driven up the prices of Toyota, Honda, and Nissan cars in the U.S., causing these models to lose their major competitive edge advantage in the market. According to the latest report from the Japan Automobile Manufacturers Association, Japanese car sales in the U.S. have dropped by about 7% in the first quarter of 2025. Meanwhile, U.S. automakers such as Ford and General Motors are attracting more customers due to government protection policies. This price increase not only reduces consumers' purchasing power but also harms Japanese automakers as profits sharply decline and production costs rise. Japan responds beyond words. However, Japan is not just responding with tough rhetoric. In fact, it has started selling off a large portion of the U.S. Treasury bonds it holds. Japan is currently the second largest creditor to the U.S., with over $1.1 trillion in bonds. In February 2025, Japan sold $30 billion worth of U.S. bonds, and this decision weakened the U.S. dollar and increased interest rates in the U.S., creating significant financial pressure. This is a high-risk financial strategy, as Japan is using its financial influence to directly affect the U.S. economy. Additionally, Japan is shifting its car production lines out of the U.S., with a significant portion of manufacturing moving to Mexico and Southeast Asia. This helps Japan minimize the impact of tariffs while still being able to supply products to the U.S. market without facing high tax rates. Japanese automakers like Toyota and Honda are heavily investing in manufacturing plants in Mexico and Southeast Asia, where labor costs are lower and unaffected by the protectionist tax policies from the U.S. This not only affects the U.S., but also makes international investors more cautious about purchasing U.S. bonds, especially as Japan is reducing its investment in this market. Future strategies. If the U.S. continues to make tougher decisions, Japan may escalate its retaliation measures. One possibility is to limit the export of core technologies, particularly solid-state batteries, which are leading the electric vehicle industry. Japan, with automakers like Toyota and Honda, is at the forefront of this technology. If the U.S. imposes tariffs on Japanese electric vehicle technologies, Japan might halt the export of solid-state batteries, which would significantly hinder the development of electric vehicles in the U.S., especially at a time when the U.S. is trying to boost electric vehicle production. Additionally, Japan could increase retaliatory tariffs on imported U.S. goods, directly impacting consumer products, machinery, electronic components, and even food. Cooperation with the EU and market diversification. While continuing to strengthen its cooperation with the U.S., Japan is actively expanding its trade relations with the European Union, EU. This will help Japan reduce its dependence on the U.S. market while creating additional opportunities for its automotive industry to grow in other markets. The EU has signed trade agreements with Japan, helping to expand the market and mitigate the risks from the possibility of further U.S. tariff hikes. At the same time, Japan is increasing electric vehicle production in these markets to maintain its competitive edge. The EU is not only an important market for Japanese cars, but also a strategic partner in providing new electric vehicle technologies, ensuring that Japan is not left behind in the global trend. Will Japan be able to force the U.S. to change its tax policies, or will the U.S. continue to take a hard stance, causing widespread financial impacts? Stay with us to find out more in the next video. Over 800 billion USD evaporated. Tesla has lost more than 50% of its stock value in less than 6 months. Why is the electric car giant, once unstoppable in its success, now facing the risk of collapse? The numbers don't lie. Tesla has evaporated nearly 800 billion USD in market capitalization, an enormous figure, not just for an electric car company, but for any company at all. And it doesn't end there. Tesla's stock dropped more than 15% in just one day, and then fell another 3% after hours. Investors, who once saw Tesla as a cash cow, are now facing big questions about the company's future.
But China is a different story. A 10% tariff on Chinese imports went into effect at midnight. China retaliated immediately, a 15% tax on U.S. coal, 10% on U.S. crude oil, and large displacement cars and pickup trucks.
Recently, China has raised the import tax on electric vehicles from countries outside of China, including Tesla. According to a report from the China Customs Administration in December 2024, the tax on Tesla's products has increased from 15% to 25% on high-end models like the Model S and Model X. This increase in taxes raises production costs, especially as Tesla relies on imported parts from other countries, such as the US and European nations. Tesla is facing difficulties as its high-end models become more expensive and less accessible to Chinese consumers. For example, the price of the Model 3 is around 43,000 USD, while the BYD HAN EV costs only 30,000 USD. BYD and NIO are dominating the market with lower prices and comparable features. In 2023, BYD sold over 1.2 million vehicles, capturing 25% of the electric vehicle market in China, while Tesla only sold 350,000 vehicles. The shift in consumer preferences in China is becoming increasingly strong, with consumers prioritizing domestic vehicles that are more affordable. If Tesla doesn't adjust its pricing strategy and improve its technology, it could lose its position in the largest electric vehicle market in the world. Tesla's market share in the U.S. has dropped significantly from 79% in 2020 to just 54% in 2023. In Europe, the situation is even worse, with sales dropping by 30%. This decline is not only due to intense competition, but also because of Elon Musk's political views, whose controversial statements have eroded customer loyalty. Tesla is no longer the only symbol of innovation. Rivals are steadily taking over the markets that Tesla once dominated. Tesla is gradually losing its connection with old customers, and this is creating a gap that competitors can fill. The political controversies surrounding Musk have damaged Tesla's image, causing many customers to turn their backs on the company. As Tesla's stock continues to plummet, investors are worried that Tesla may not be able to overcome this crisis. One of the main reasons for the sharp decline in Tesla's stock is the loss of investor confidence. They no longer see Tesla as the cash cow, but as a company facing numerous challenges. Not only are there issues with stock prices, but Tesla's financial reports are also raising concerns about the company's ability to maintain profitability. Specifically, production costs are increasing, while demand from the market is declining. Maintaining high production levels without being impacted by tax costs or the effects of international policies is a huge challenge for Tesla. If you want to know if Tesla can overcome this crisis and how Elon Musk can maintain his position in the electric vehicle industry, don't take your eyes off this video. Fascinating insights and deep analysis are waiting for you ahead.
Yesterday, President Trump addressed last week's stock market turmoil caused by confusion around his tariff agenda.
Japan's shocking move, economic retaliation, that worries the U.S., financial markets in turmoil. Japan has just taken a step that could shake the U.S. economy. They are quietly selling off large amounts of U.S. Treasury bonds, an unprecedented move. What does this mean? Is Japan trying to put pressure on the U.S.? And how big will the impact be? Japan cuts U.S. bonds. A warning for Washington? For decades, Japan has been one of the largest creditors of the U.S., holding hundreds of billions of dollars in Treasury bonds. This has helped finance U.S. debt and stabilize the dollar. But recently, Tokyo has significantly reduced its holdings of U.S. bonds. According to the latest financial reports, Japan has sold tens of billions of dollars in U.S. Treasuries over the past few months. This is a concerning move. Why is Japan doing this? The answer may lie in the growing trade tensions between the two countries, particularly over U.S. tariffs on Japanese electric vehicles. The U.S. government has imposed high tariffs on imported EVs, including those from major Japanese automakers like Toyota, Honda, and Nissan. Tokyo is not happy, and now Japan seems to be using its financial weapon to retaliate against the U.S. But the bigger question is, if Japan continues to sell off U.S. bonds, what will happen to the dollar and the global economy? The U.S. protects its EV industry. Japan strikes back. To understand this, we need to look at the U.S. strategy. The U.S. is pushing to develop its domestic EV industry, aiming to compete with China and Europe. American automakers like Tesla, General Motors, and Ford are receiving massive government support, while imported EVs are hit with high tariffs. But why is Japan affected so much? Because Japanese automakers lead the world in hybrid and EV technology. For example, Toyota pioneered hybrid cars with the Prius. Nissan was one of the first to mass-produce EVs with the Nissan Leaf. Honda is rapidly expanding its EV lineup. Japan believes it has superior technology, yet the U.S. is blocking its products with tariffs. And that's why Tokyo is retaliating financially. Cutting U.S. Treasury bond holdings sends a clear message. If the U.S. continues protectionism, Japan will stop supporting the U.S. economy by buying its debt. The key question now: how long can Washington endure this pressure? Is Japan trying to reduce its dependence on the dollar? Another major reason for Japan's bond sell-off is its desire to reduce dependence on the U.S. dollar. The global financial system is shifting. China is reducing its dollar reserves and promoting the yuan. Russia has cut U.S. bond holdings following economic sanctions. Other Asian nations, like South Korea and India, are diversifying their foreign assets. Now, Japan may be following this trend. Tokyo could redirect its capital into Asian markets. strengthening cooperation with China, South Korea, and ASEAN to build a more independent regional financial system. This could accelerate the decline of US dollar dominance. So the big question is, could Japan's move be the first step in a major shift in the global economy? If Japan continues selling bonds, how will the US respond? Can the US ignore Japan's warning? If Japan continues to sell US bonds, the dollar could be seriously impacted. A worst-case scenario could unfold. Dollar value declines, increasing import costs and causing inflation in the US. Higher US bond interest rates, raising borrowing costs for the US government. Global financial market instability, creating a domino effect on the world economy. The US has two choices: compromise with Japan, reducing EV tariffs to maintain financial stability, continue the confrontation, accepting financial and trade risks. Both options carry major risks. The biggest question now? What will the US do next? We are at a critical moment in economic history, and this may be just the beginning. Stay tuned for the next developments.